the advantage they have over, say, public companies, in that private equity are virtually always willing to buy and sell. Every asset is for sale, and they are always willing to buy a new asset. Public companies are slaves to the cycles of the stock market, and very often, in my experience, public companies are forced to sell at the bottom and buy at the top. And it astounds me how often I come across situations where there's a public company in a particular sector that will know that industry very well and have huge synergistic advantages of making a strategic acquisition. But for a variety of reasons, they're too slow, or it's at the bottom of the market or whatever, they can't make the acquisition. Private equity, which doesn't know the industry as well and doesn't have any synergistic benefits, makes the acquisition and then flips it to the industrial buyer a few years later at a huge profit. And, you wonder, why does the public market always end up paying more? And I guess it's because private equity are ultimately really M&A specialists. All they do is buy and sell, in a sense. And that's what they focus on. They're small and flexible, and they have this great timing advantage, which really plays to their strengths.
Yeah, I agree with you. I think it's one of those things, and there isn't a problem with it as long as those rewards are accessible to as many people as possible. One of the problems is that anyone can invest in the public markets, but it's increasingly easy to invest in private equity vehicles, but it's still pretty difficult for your average Joe.
Yeah, and of course, as we know, private equity still only represents a tiny proportion of the overall savings and pensions money out there. And as a proportion of overall institutional and individual portfolios, it is growing. But it's still, I would imagine, worldwide, under 10% across most diversified forms of savings. And it is going to grow. Structurally, more allocation is going to be devoted towards private investments of one sort or another, be it VC or PE. That's probably a good thing. I'm not surprised, even though, 2 and 20 relative to public market management fees is high. The level of attention required in investing in private companies is a great deal more intense. So, I would argue it's justified to an extent. And the returns are there. And another area where I think private markets have an advantage is they are more willing to put higher levels of debt into investments, generally, in my experience. Public company fund managers don't generally like to invest in companies that have 3, 4, 5 turns of EBITDA senior debt, whereas many PE houses are perfectly comfortable with that. Indeed, they would consider that a standard level of leverage for a normal buyout. So, that financial engineering in rising markets and growing businesses compounds returns.
Yeah.
And it's another advantage that PE has over public markets. It's been a pretty good game to play, I would say, private equity, in terms of accumulating returns for investors and indeed enriching private equity investors. I think, and I'm not talking about myself so much because I'm not really an institutional private equity investor or executive, but I think it's as good a career as one could pursue if, you want to get rich in a pretty safe way, because you are playing with other people's money to a very large degree. And, you get you can write very big checks. And so if you get your bets right, then you do extremely well. And to a large degree, heads they win, tails other people lose. So, private equity as a career has proved a pretty good bet. And I suspect it will continue for some time.